Hi everyone, Eli here. So this video is specifically for beginners. So this is the very basics of futures, of options on futures, and basically everything and anything around it. So, if you're a pretty advanced trader, then this is not the video or the section for you. So yeah, definitely for very beginner people or beginner traders. And at the end of the video, I go through the setup on IBKR, how to set up the account, the window. This is how I do it. So you can skip to the very end if you want to take a look at it, or you can obviously stay and kind of watch through in the order I've put it in through. So let's begin with what is the futures market. And basically, the futures market is somewhere you can buy and sell commodities to be delivered to you at a future date for a predetermined price. Or obviously you can just buy and sell commodity contracts for speculation or basically trading. So like actual producers, farmers, and actual companies, they buy and sell futures contracts to be able to get the physical products delivered to them, or they deliver the physical products, so on and so forth. Some companies use it for hedging, for whatever it might be. But overall, this is basically what the futures market is. Now, the only pretty much futures that I trade, and there are a few couple more that are pretty liquid. They have quite a good liquidity, but these are pretty much all of them: gold, silver, copper, crude oil, natural gas. Then we have the grains. We have wheat, corn, soybean meal, and soybean oil. And these are the tickers for each and every product. And from here, we also need to know that futures contracts, they have an expiration date. And I will go over it in just 1 second. So, we can buy and sell the futures contracts. If you want to get the physical gold delivered to you, it is actually possible. It's not that simple. Not everyone can just kind of be able to get physical commodities delivered to them. You need a special account, special approvals, but it is possible. Or I guess is basically what we do. We do trading on futures, and more specifically options on futures. Well, so for the futures contract expirations, something I want to show you is, so let's, for example, if you go and we type in CL, which is crude oil. So you can see here we have different expirations for the futures. So we have May, June, July, August, and each one of them has a specific letter. So K, M, N, Q, so on and so forth. And usually year after year, it's usually the same letters that kind of go over and over again. So May is always K. So you can see CLK 2025. So it's K is for May, and 2025 is the year, obviously. Now, you don't have to remember the letters. I really don't. It's kind of like irrelevant, but it's just good to know that they are there. And this is what will be considered the front month. So the May expiration will be the front month for crude oil, which just means it's just the closest expiration for the crude oil. That's about it. Now, as of which one we trade, it's also not a big deal. And when we get to the option side of it, you will see it's pretty simple. And I will explain to it, but usually whatever options you decide to trade, they are automatically tied to one of these. So you really don't have a choice. You just gonna go with what it says, and you just trade the options on one of the contracts that is predetermined by the options. So this is for the expiration. So let's just choose any of them. Let's just go whatever May. So this is the May expiration. Let's just get rid of this stuff. Now, the next thing is futures are extremely leveraged, and they have what is called a multiplier. So basically, for every $1 move, so if we bought, for example, crude oil at $62 a barrel, and we are going to sell it at 63, so we have a 1 point difference, or a $1 difference, and this $1 is actually worth $1,000. So and this is the contract size. This is also the multiplier. So basically, for every $1 move of crude oil, you will make or lose $1,000 per one contract. So if you buy one contract, the price goes up $1, you make $1,000. So it's 1,000 to 1 leverage, I guess, in a way you can call it. But this is the multiplier. So let's go, whatever, let's choose gold. I have gold already open here. So gold, the multiplier is 100. And it's different for each and every one of them. This one is, I believe, 25,000. For copper, for silver, it's 5,000, I believe. So it's different for each and every one. So for silver, each dollar move is basically worth $5,000. This is how it works. This is how it's calculated. The natural gas, for example, is 10,000. And this is basically why there's baked-in leverage in futures contracts. Now, we trade options on futures, but it's also good to know, obviously, what kind of leverage you are basically playing with, even though, I never really end up buying or selling the futures contracts themselves. But it's just good to know. And the contract size here, or the multiplier, is also the same one we will have for the options, and we will get to that shortly. Now, the next thing will be the opening hours. So the futures market is open 23 hours a day, basically, and there's only one break between 5 and 6 p.m. And obviously it's closed on Saturday, but it opens on Sunday, 6 p.m. Right? So again, the futures market is trading 23 hours a day. It's only closed between 5 and 6 p.m. Saturdays are obviously off the limits, for now at least. Maybe they'll change it in the future. And then the market opens up at 6 p.m. on Sunday. So you have a really, really good trading hours, which means you can also trade options during these hours because the futures market is open. Now, this is for most products, specifically for the ones we trade. So for the grains, it's a bit different. They are open all day, but they are closed every day between 2:20 p.m. and 8 p.m. This is just the hours, but they are open the rest of the day. And again, on Sunday, they open at 8 p.m. instead of 6 p.m. This is about it, but they are open all day long, but only closed between 2:20 p.m. and 8 p.m. So they are open overnight, basically, as well. And this is really important to remember, and it's obviously a really favorable trading hours, especially if you have a job, or if people have jobs, like I guess day jobs that they have to attend. This is pretty good because you can trade, you can trade the options on those futures at 8 p.m., which is really what I do. I have kids, so it's much easier for me to kind of put them to bed and only then open my positions, and it's been working just wonderfully so far. So let's go to the next section. This is all about the futures market. I think it's pretty straightforward. It's nothing too complicated, and I'm keeping it very simple. Obviously, we can go into a crazy amount of complications, but I think over time, traders that are really into it will just kind of pick up on the little things. And there are, the little things are really not that important at the end of the day. So I'm just gonna, I'm just kind of focusing on what is actually useful to an extent. So let's go next. So let's go talk about options on futures. So options are pretty much like insurance. So you can buy or sell them in different creative ways. I always sell options. And if you think about it, the one who sells insurance is basically the one that's profiting. So your car insurance company, they're definitely making more money than you do by buying insurance from them. They collect insurance from you and probably another 100,000 people. Obviously, some people have accidents and they have to, or people have maybe a total loss on their car, so they have to pay it off. But at the same time, they collect a lot of money every single month. And, because they're selling you an option that expires at the end of each month. So if you pay $300 for a car insurance per month, they sell you, and then you have the option to obviously claim whatever a total loss on your insurance by the end of the month, because you paid the $300. And if, for example, next month you don't pay the $300, then you for whatever reason, then you don't have the right anymore to kind of claim anything under the insurance policy. So obviously they are the one that make money, and we want to act as the insurance company, and we want to basically sell insurance on futures. And like I said, there's many different ways that you can do it, and I'm going to focus obviously on what on what I know best, which is neutral trading, so I don't have to kind of think where the price will go up or down. So it's a bit it's way more safer, and it just makes way more sense in my mind. But again, this is what options are. So basically, options provide you even more leverage. So it's kind of leverage on leverage if you sell options on futures, and this is why it's so risky for some people. But at the same time, if you know how to control the risk, you know what, and you can understand where you can exit a position or where you can kind of protect yourself if anything happens, then this risk becomes really your advantage, and you can turn it into a pretty good profit. So let's talk about the options characteristics. So options, they also have an expiration date like futures, and options lose value as you get closer to the expiration date, and it's called theta. This is how the loss value is measured. It's by theta. And so, like we said with the car insurance company, if you paid $300 for this month for your car insurance, at the end of the month it's gonna be worth zero, basically. So it's kind of the same principle, right? And if you ever cancel your insurance midway through the month, you will get reimbursed half the amount, because you already lost half of the amount due to time decay, because your expiration date was at the end of the month, because you pay only per month $300. So you will get back $150 if you would have canceled halfway through. So it's kind of the exact same thing. We are going to sell insurance, and the closer we get to the expiration of the insurance, because options, they have an expiration like futures, we will be able to collect more and more of that money. Now, options have a multiplier. We just talked about it. It's the same number as the futures, and I'll show you everything in a second. And this is pretty much the gist of options characteristics for now. So we have an expiration date. So let's see what it looks like for the expiration date. So this is an opt-in chain for the SPX, doesn't matter. So you can see here, and this is Interactive Brokers. And obviously at the end of this video, I'll go over exactly how to set it up. But every broker is a bit different, but it's all about the same. So you can see we have 0 days, 1 day, 2 days, 3 days, and so on and so forth. So over here, for example, let's go to 37 days to expiration, right? So this just means we have 37 days until the option will expire. And then we have all the options over here for different prices, and you don't have to worry about all these numbers for now. We will go over it in a second. So let's also see, let's type in crude oil. We'll go to futures, and it doesn't really matter which future. This is the futures expiration. It doesn't matter which one you choose. You can just choose any of them. It will always open all the option chains. I will get rid of the weekly expirations. So let's, for example, go for this one, 37 days to expiration on crude oil. So we can see we have May and June. So if you kind of hover over it, so we can see that FOP, so the futures options less trading day, is May 15th, which means this option is going to expire on May 15th, which is 37 days from this point. And the underlying future contract expiration is June. So the expiration for the future itself is going to be June. So this is how you know which future expiration to look at, right? So 37 days is when the option will expire. And how do you know which future contract you're trading? You just look and see what is the second month here, or you hover over with the mouse, and you can see this is the crude oil futures expiration that expires in June. So I know it's a bit confusing with all the expirations, because options and futures have expirations, but the first month will always be the option expiration, and then the second month will always be the futures expiration. So this is pretty handy to remember. Now, this is how we know how many days we have for the option to expire: 100 days, 69 days, 8 days, so on and so forth. Now, options lose value as you get closer to expiration. We talked about this. There's nothing to show on the broker, but options also have a multiplier, same value as the future. So if you remember, the value for crude oil was 1,000. So if you go ahead and click crude oil futures, so you can see 1 point equals $1,000, and this is exactly the same. So basically, what it means to you is every single number over here you would multiply by 1,000. So for example, if we want to go ahead and sell this option over here for 3.37, so you would go ahead and sell it for 3.37, and the amount of money you will get paid is 3.34 times 1,000, which is 3,340. This is just the multiplier being used here. Now you don't have to remember the multiplier. It's all done automatically for you. I remember it just because really, when you look at it many times, you're just gonna get to remember it. But it's not super important. But again, good to know what is the multiplier, and you never really have to manually, decide what to multiply the each and every one of those numbers for different commodities. Now, options, they also have calls and puts. So obviously you can buy and sell them. When you buy a call, you pay a premium and you expect the price to go up. When you buy a put, you also pay a premium. So anytime you buy anything, obviously you have to pay for it, and it's called a premium. And when you buy a put, you expect the price to go down. Very simple. So for example, we have the puts on the right side here. This is also something to remember. And calls are always going to be on the left side. Now, each and every broker will look a little bit differently, but it will always be the exact same. Calls are on the left, puts are on the right, and in the middle we have something that's called the option strike. So it's just basically the price that you're looking to sell the option for. And we'll get to it. It will make much more sense. You don't have to remember strike. It's just this middle column, and this is what you decide to buy or sell at whatever strike price. So puts are on the right, calls are on the left. So for example, if I decide to go and buy the 62 call option, which is going to be on the right side, then if you go to the ask side, so this is the ask, and you can also see it's also blue and it says buy leg. You press buy. So basically it means that you will be buying and paying for this option at strike price 62. And basically what happens here is you will want the price to go up, and I'll go over exactly what it means in just it's actually the next slide, but this is what it looks like. And if you want to sell, you're just gonna press the other side, the bid side, and you will be selling the option. Now when you sell a call, you get paid the premium. So here you pay the premium when you buy the call, but when you sell, you get paid the premium, and you expect the price to go down. So you basically expect the other way or the other thing to happen as opposed to when you buy it. So when you sell a call, you get paid and you expect the price to go down instead of going up. And when you sell a put, you also get paid a premium, and then you expect the price to go up instead of going down when you buy a put. It's a bit confusing. I promise you it will make a lot of sense over time. But you have to remember that it's just the other way around from buying, and over time it will just become basically second nature. So let's go for buying versus selling options. I think it's also going to be really important. So obviously selling options, like we talked about, you will be selling premium, you will be selling insurance. You're going to be much more profitable that way. And it just has a much higher probability of consistent profits. So again, if you think about it with the car insurance example, what is the probability that even 10% of the car insurance company clients will get into crazy accidents at the same day or at the same time? It's pretty low. They might get into accidents eventually in their lifetime, but by that time they paid a lot of premium to the car insurance company every single month, and they have a lot of cash to be able to to repair, fix, or pay out if it's a total loss. So that's why you have a much higher probability when you sell options / insurance. So again, when you buy a call or a put, you need the price to go in your favor and quickly and sharply. So when you buy a call, you want the price to go up. When you buy a put, you want the price to go down. And I will go and illustrate everything on the graph actually in just a second, so it will make a lot of sense to you. Now, why do you need the price to go in your direction quickly and sharply? Because, as we remember, options, they lose value over time, which is theta. So if the price doesn't move in your direction quickly enough when you buy options, then you run the risk of losing value, because the options, they just lose value towards expiration. Well, basically what it means is, if the price doesn't move or goes against you, you will lose, right? So 2 out of the 3 ways that the price can possibly move, the price can go up, down, or up, down, or stay the same. So if the price doesn't move or goes against you, you will lose. And this is what happens when you buy options. And again, options lose value every day since you pay the premium to buy the options, you can only lose the amount you paid, and there is actually no more risk, but the price has to move in your favor. So let's go over an example for buying options. So for example, let's say, let's go over here. Let's say we are looking at the June expiration, 37 days. Actually, let's go to the May expiration, because this is what we have opened on TradingView, 8 days to expiration. So let's say we want to buy the 62 call option. So we're gonna go ahead and buy it, and we are going to pay $830 for it, which is the max loss basically for this option. So this is how much it's going to cost us to buy this call option. So call option means we need the price to go up. So basically the price is at, what is it? Crude oil. We need the May expiration. Perfect, May expiration. So we need the price, or we need, let's see here, 62. So basically the price right now is 59.07, and we are buying the call option for 62. So what it means that we need the price to go up and at least be at our level over here to be able to have a chance to profit on the position, and the price has to go up and above the 62 level by the end of the expiration, which is 8 days. So within 8 days, the price has to go up to 62 for crude oil on this contract, which is May, for the futures. And if it doesn't go up, even if it's a cent away within 8 days, or after the 8-day period, which is the expiration, then you lose all the premium that you paid for the option, which is $830. Right? So if the price stays the same, you lose. If it goes down, you lose. If it goes up but not enough to be over the price of 62, you lose as well. So basically, you have many ways to lose here, unless the price goes in your favor, which is up, and pretty quickly to go over the 62. And again, if it doesn't, then you lose everything that you paid for. This is why it's not profitable, and you can see that you have to really nail it. Really be really accurate. So you cannot be wrong. If you're wrong, you will lose money. Even if you're right, you might lose money. So price might go up, but not quickly enough, you will lose money, right? So this is why buying options is really, really tough and usually not really profitable, just because the nature of how prices move. And there's no way to know how quickly you will move up or down. And obviously, if it would have been profitable to buy insurance, everyone would have been doing it. Sometimes it is on rare occasions, but usually it's not. Now, and as you saw, I chose strike 62. You can choose any strike. So if we chose strike 64, for example, we would have paid a bit less, because we are pretty much not as close to the current price. So we would have paid $370, and this is the max amount of money that we can lose. But at the same time, now the price has to move quite a bit more within 8 days for me to be able to at least have a chance to profit. Now, how much will you profit? I'm not going to get into the calculations right now. It's not that complicated, but you need the price to be at least at, let's see, it's going to say exactly here. So your break even is at 64.37. So the price has to be at least at 64.37 for you to just break even on the position, because 64 is your strike and you paid $370, which is 0.37, and this will be your break even. So you need the price at least to get to that level at the end of the 8 days for the expiration, just to break even. So, and if it goes anything above it, then you'll start profiting. Now, how much will you be profiting? It just depends. And I mean, there's a nice graph here, but basically, if it goes, let's say, to 64.91, you'll be up about $538 on this position. And again, it depends how quickly you will do it. If it's done quickly, or if the price will move up today, then obviously you will be looking at this graph over here and not this smooth line. This line shows you what happens at the expiration, and this dotted line shows you what happens, as of today. So April 8th, which is today. And again, don't worry about this stuff too much. I have other videos that explain exactly what I'm looking for here, but this is basically what happens when you buy this option. Now, let's talk about what happens when you sell an option. A call, a put, doesn't matter. So you'll profit if the price doesn't move or goes in your favor, because time decay is now your friend. So within 8 days, this option will be worth 0. So obviously, if you sell it, the price doesn't move, you get to keep all the premium that you received. Now, theoretically, there is no max loss, as opposed to when you buy options, you can only lose what you paid. Here, because you don't really pay anything, you get paid right away. Your max loss is unlimited, and you can basically blow your entire account on one trade. But obviously, it's not, it's not that simple. And this is, I guess, something that throws people off quite quickly. But this is just part of the risk that we need to manage, because we have a higher probability of making money. So, and we have one more thing is, because you get paid to sell them, and you will have to offer some of your account value as collateral to the broker, which is what they call margin requirement. And we'll go over it in just 1 second. So let's do the same thing. Let's sell the call that we just tried to buy, and let's see what it looks like on the graph. So let's go to call strike at 62. I'm going to sell this call option. So right now, if I sell it, we are going to get paid $840, and this will be our break even currently. So it's 62.84. So let's go over here. We'll plot it on the graph. So 62 is our strike. So basically, as long as the price stays underneath 62.84, or let's simplify it. Let's put it 62. As long as the price stays under 62, we will get to keep the $840. So the price can go down, and right now we sold this option. So let's make it red. The price can go up, the price can go sideways. Doesn't matter for us. We just want the price to stay underneath this strike of 62 for us to be able to keep the entire credit of $840, which obviously you can see there's a way higher probability that the price is just going to stay underneath it, as opposed to just go right up. Anything can happen, of course, but you have way more ways to profit when you sell options as opposed to when you buy them, because you don't really need the price to move anywhere. You can just stay and do nothing, and the option will be losing value in real time, and it's going to be worth 0 at the end of the 8-day expiration. And again, the break even will be the same thing. So even if the option goes all the way up to 62.84, which is our break even over here, at that point you will not be losing anything. You will be just breaking even on the option, because the strike is 62 and we got paid $840. So we have a bit of a cushion above 62. So this is how it works when you buy and sell, and you can clearly see. So when you sell options, it will definitely go much in your favor. And you can also do some pretty creative things, which is what I do. I'll give you a little glimpse. So you can sell a call and at the same time sell a put. Let's do it this way. So we sold the 62 call, we sold the 57 put. So basically what happens here, we create a range for the price to bounce in between. As long as the price stays within this range, these options will keep losing value and they will keep making money. So if we have 62 and 57, let's see over here, and then 57 will be right here. So as long as the price stays in between these lines, we will be making money. And how much money? Well, now because we also sold the put side, we will be getting paid $2,170. And if the price stays in between our lines, we get to keep the entire amount, right? So it's quite a bit of money, and obviously it's not that simple, but this is what I do. I sell options neutrally, and basically, you can create different amounts of range that you want to go for, and they have, different characteristics, so on and so forth. And but this is basically the gist of why selling options is more profitable. Now, because we sold the call and the put, right, we get paid. We get paid $2,170, right? Now, obviously, we will have to offer some of our account as collateral to the broker, just because we got paid, we're taking more risk instead of just buying options. And the margin requirement is $8,817 for this position, which means $8,817 out of your account will be held up as collateral for this trade, basically. So it's nothing crazy, nothing unusual. It's pretty normal, pretty standard. Now this number can change. If the risk goes up, it can inflate. It can also go down. Usually it goes up a little closer to expiration, but it depends. It depends on the broker's calculations of the risk of your position and based on what's going on in the markets. But basically, this is how much of your account will be held up, and you cannot use this amount for anything else. It's held up by this position, and obviously, it's including. It's after you get paid the credit, right? So actually, it's the margin requirement is higher than 8,000. It's 8,817 plus the 2,170, but the net margin impact is 8,800. So this includes the credit that you're already receiving. So you don't have to subtract the credit from this amount. It's already including that with interactive, right? So this will be held as collateral on your account. So again, this is margin requirements, really important. You really want to keep that in check, and you definitely want to, not overuse it, because you can only really use probably like 85% of your account. At 90%, the broker will basically either close some of your positions, or send you messages and telling you to close some of your positions because your margin requirements are way too high. So because you're using 90% of your account in margin requirements. So you definitely want to keep that number low. I at most, I don't want to go over the 65-70% at most. But usually, I keep it to well under 50% of my account. Now, selling options is proven to be extremely profitable and consistent. But it is obviously more complicated, has more risk. Obviously, as you saw, we have an unlimited amount of drawdown, but obviously you have stop losses. You have many things you can put in place. Just like any insurance company, they have many policies, many ways to make sure they protect themselves, and like basically any other insurance company. So here you will be operating your own insurance company. You're gonna have no clients. You will be just you in the market, but you will have to create those rules for yourself to be able to protect yourself against big moves against you in the market, which again, everything is really possible, really not such a big deal. So let's go over more specifics for the options. Okay, so we have delta. Now actually there's quite a few things here, and it might get a bit scary, but the only few things that you really want to kind of focus on is delta and margin requirements, which we already covered. The rest is good to know. I don't ever really look at them at this point. It's just good to know that they exist. But they're definitely not something I use in my decision making. What I use is delta and margin requirements, and even implied volatility, which I'm going to go over loosely in this video. So delta, what is delta? So this is the fancy explanation. So the delta is the rate of change per 1 point move of the underlying. So just a really, really fancy explanation of what delta is. In the real world, delta is used to just tell you the probability of profit for a position. So let's see what it looks like. So let's see. We have the delta right over here. So this is the delta column for the call side. This is for the put side. So let's sell a strangle, or let's sell the call 62. We have a delta of 29.5. So basically what it tells you is your probability of profit when you sell the option will be 1 minus that, which is about 70.5%. So you have a 70.5% chance to profit on this position, which is right over here. Well, and the broker will always give you a bit more of an accurate calculation. And again, so you don't really have to know the stuff, but it's really important to know it. If you want to become a professional, you got to be able to to tell approximately what probability you have. So in this case, we have a 75 chance probability to make money on this position. Now, if you go ahead and you buy this option, it means you only have about 28.8% chance of making money on this position, and now the broker is going to be a bit more accurate, 25%, which obviously makes sense because we had 75% chance to make money on the position when we sold the option. So it's quite accurate. It's not the exact calculation, but it's, if someone tells you, hey, I sold a delta 30 call option, well, they have about a 70% chance of being profitable in this position, right? And you don't really have to know exactly what's going on. Now, what happens if we sell a call at delta 28.8 and we sell a put, let's say delta 28.2, right? What is our probability right now? Well, it's pretty simple. You just connect them both. So if you connect delta 28 and delta 28, and they're both short positions, we are looking at a delta of 56 in total. So it means you will have about a 50 or 56% chance to lose on this position, or about a 44% chance of making money. Because remember, if it's negative, you always go 1 minus whatever number there is. And if you buy the option, then it's just the number, whatever number you see is your probability of profit. So here we expect about a 44% chance of profitability. Again, the broker has a bit of a different calculation. It's actually 65 in this case, but it depends on market conditions, and strangles are also they're a bit different to calculate. But this is basically how you can use delta to help you with the probabilities. What I usually do specifically is I go usually delta 21 on each side, give or take. And again, we're looking just at 8 days to expiration, so it's not as accurate as I would like it to be. If, for example, we go to like 100 days to expiration, for example, so let's go and sell the delta, delta 21 or delta 2021, doesn't matter, on the put side, and then the delta 21.6 on the call side. So we're looking at about a 70% chance of probability of making money, which if you look at deltas, it should be about 60%. But this is, again, how you use the delta, and it just kind of tells you basically what kind of probability of chance you have. Now, let's go back for 1 second for what is the rate of change per 1 point move of the underlying. So this is the fancy explanation of delta, so let's just quickly go over it. So for example, if I just go and I sell, or whatever, let's say I buy the call option at strike 69, and we have a delta of 20.5 or 0.20.5. I just call it 20.5. What it means? This means that if the price of the future goes up by $1, which is from 59.27 to 16 or to 60.27, this position will gain 20 cents. So this position will be worth not $1.20 but $1.45, or let's just call it $1.40. Sorry. This is what it means. So it just means that for every $1 move of the underlying, this option will gain or lose 20 cents, if it makes sense. So it's basically the definition of delta. But again, I never really even look at the delta this way. Not really useful for the most part. And you can see here the higher the delta, the more aggressive it is. So a higher delta will be way more susceptible to the price move. A lower delta will be less susceptible. And you can go as low as like delta 6.8, 6.54, whatever it might be. So this is it for the delta. Now let's talk about the theta. So theta is the amount in dollars the position is losing every 24 hours. And let's see where we can see it over the on the broker. So that's whatever. Let's just go and again, let's go and sell the 69 call option with expiration of 100 days. And our future expiration here is the August month. So if you go to the profile, we can see here the portfolio theta. So portfolio theta tells you just in dollar amounts how much is this position going to lose every 24 hours, and it's going to lose $15.85. As you can see, the theta here is positive, which means it works in your favor. If we buy this position, it will show up as negative because theta is going to be not a good thing for us because we are buying the option. Now you can go for instrumental Greeks. Then it will just show you the theta before the multiplier multiplication, right? So I always just look at the position Greeks, and I know exactly what theta I'm getting. So how much the position will be losing, and it's really dynamic. So if the price goes up or down, the theta will change for different positions. I don't really look at this stuff. I don't really even care about my theta too much. When I open a position, I just I focus on other things, which is again gonna be in another video. This is just the very basics and fundamentals, but this is your theta. This is basically it. So nothing too interesting about the theta. Now we have the gamma. So the gamma is just the rate of change of delta. So big gamma means that delta is way more susceptible to change quickly. Low gamma means that delta is changing slowly, because the rate of change of delta is also important. And I'm not gonna go any more details on gamma because I never ever really look at it. If you trade short expiration options, gamma is basically not your friend, it's against you. It basically, if there's a big gamma and you sell options with low days to expiration, with a low amount of expiration dates, which is anything under 20 days to expiration, basically means that you can get into a really bad situation really quickly, and vice versa, because gamma is big, which means delta is very sensitive to the price movement. Now Vega is the position sensitivity to the change in volatility. Also somewhat important. I don't really look at that number as well, but over here again, if you look at the profile, you can see your delta, your gamma, and your Vega as well. So this is how much the position will make or lose if the volatility basically goes up by 1 point. So volatility goes up by 1 point, and you will lose $86 on this position. Now by what point? Where is the point? Well, the volatility should be over here. I don't know why it doesn't show it, but at the same time, again, I don't really look at the stuff. And over time, you'll learn to understand where the Vega is bigger or smaller in terms of what delta you choose. Different deltas have different Vegas, and there's a whole thing. And we're not gonna get into it. It's not really important currently. what is important is to understand what exists, and then over time things will just become more and more clear the more you're gonna go over and trade. So let's go over IBR. So IBR is just implied volatility rank. It shows us how volatile the underlying is relatively to the previous year, to the previous 3 months, 6 months. It's whatever you choose. I'm not gonna go over it too much. It's definitely good to know about implied volatility, and there's a separate video and section for volatility and how I look at it for commodities, because again this entire video and everything I do is specifically tailored to how I trade and how I use each and every point of data, or don't use. So this is not a video that will teach you about every single thing in detail, where you can use it in different strategies and ways. This is specifically on how I do things, because this is what I know best. This is the only thing that I can stand behind. So IBR important to know about. I don't really use it anymore. I use something called CVOL, the commodity volatility index, which is just a different version of IBR, but more accurate and easier to look at. And there's a separate video about CVOL as well, so CVOL. So let's go next to the margin requirements, which we already looked at and talked about. It's just the collateral held by the broker when you open a short position. You can also have some margin requirements when you buy options. It will be very, very small. Yeah, so it will be pretty much almost the same amount that you pay, because this is basically how much you are going to pay for the position. This will be the capital held as collateral, because you need to be able to lose that amount to be able or you need to be able to have this amount in your account to be able to purchase the option for 1,170. So nothing too interesting over there. Now there's intrinsic and extrinsic value. So we have OTM, which is out of the money options. We have ATM, which is at the money options. And we have in the money options. Again, it's all fancy names. Might be confusing, might be not. All you need to know is out of the money and at the money options, they have purely extrinsic value, which means this is basically what the option can lose. And when you have intrinsic value, this is basically value that the option cannot lose. So if you're in the money, so if the price is past your option price, then it has an actual value, and it cannot lose that actual value. So it doesn't matter what theta you have, or if you buy or sell, doesn't matter. You cannot lose that value. So it becomes a bit more like just holding the future itself, the future contract itself. Again, nothing crazy. Out of the money, at the money, and in the money. Let's go over it very quickly. I think it will be very simple if you look at the SPX actually, but it's nothing too crazy, nothing too important, and I don't really kind of think of it. So as you can see, the current price is 5,048. So it's right in between 50.45 and 50.50. So right now these options over here will be considered at the money. So this option, this option, this option, and that option, they will be considered at the money options because they are exactly at the current price of the underlying. Now on the call side, you can see we have the shaded blue area. So everything in the blue area is always in the money, which means the price has already surpassed, or the underlying is already surpassed, went over the strike price. So strike price 5,000, the price already went over it by $48, right? So this will be worth basically at least $48. Again, there's the different multiplier here, so on and so forth. But this is in the money options for the call side. Put side, the same thing. It's in the money where you have the green shaded line. And then out of the money is basically everything else. So it's everything that the price hasn't reached just yet on the call side and on the put side. And out of the money options, so these options, and at the money options, they have purely extrinsic value, which means they can lose all the value they have. and anything in the money is mostly intrinsic and very, very little extrinsic, but again, it's not really relevant too much, but good to know. And obviously they cannot lose their entire value. It just doesn't work this way, because they are actually worth something, because the price has went over those strikes over these options. So for the most part, this is, I think, basically it. Now, we already talked about the probability of profit, which is really important, which is what delta is used for. But again, your broker will display the numbers for you as well, which is, I think, really important. Let's see how do I set up my Interactive Brokers account. So let's go ahead and just open a new window. Let's call it new. So I think this is also pretty important, because some people really have struggled with it, and I know this platform might not be the most friendly, but this is what I'm used to, and it has been doing pretty well for me. So I'll go to new window, and first of all we will click portfolio, because we want to see exactly what positions we have. Now let's go over here, and we can just put it a bit larger over here, and I keep my portfolio pretty large for the most part. Now this is a demo account, obviously this is not a real account, so it's just things that I'm trying out for now. And this is the first window that I would open up, the portfolio. The second window, it will be see here, the order entry. So it's also pretty important to have this window open over here. This is where you can customize positions, or create closing orders, so on and so forth. So I always put it underneath. Then I always go to my watch list, and I keep it on the right side. Some people don't really use a watch list, some people do. It's up to other people. And the last but not least is I'm looking at my where is it? I think I just lost it. There you go. The order management. You just click orders, and then you can see here all of the orders that has been executed, or if you have a stop loss, a take profit, it will appear over here, and then you can adjust it, and you can also add the trades. You can add the summary, so you can see exactly what happened. Well, this is how I keep everything for my portfolio. Really simple, nothing crazy. Watch list, you can just go ahead, click crude oil. Let's go to crude oil. We have futures, and then I choose whatever futures I want to be looking at. And then we have our orders. This will be always the open orders, and then you can look at trades, which is basically closed trades, the price, the commissions, so on and so forth. And summary, it's pretty much the same as trades. I never really look at it. And here we have all of our active positions, our account value, everything you need to know, profile, and here's the order entry. So think really, really, really simple, nothing too crazy. Now for the option chain. So for the option chain, what I would do is I would open a new window. So currently I have the option chain window, and then I have this window, obviously. So it's just two separate windows. I also have a graph window, which I don't really use, as you can see. So let's say we opened up a new tab, and we wanna get the option chain over here. So I will go ahead and click option chain. I will make sure it's going to be. Actually, I think we need to do this. So there's a little lock here that you have to unlock to be able to put things within the tab. I'm going to put it to full size. So, and I already have everything that I need being set up. Let's lock it, save changes. And the way you can add delta, volume, bid and ask, or whatever you might need is you just right click and you go insert column. So you would go to Greeks and you would add, what is it? The delta, what is it? Sorry. Oh yeah, we already have delta added, so it's not in over here, but we can add, say, portfolio theta, right? So now we know how much these options are going to be losing, right? I don't really use portfolio theta, so I want to keep it as clean as possible. I use only volume, open interest, and delta. And just so you know, volume is how many contracts has changed hands in the past 24 hours, and open interest just tells you how many contracts are currently in circulation for each and every strike. So for the put side, and then for the call side, these are different numbers. But this is how you would go and change the columns. I think there's many ways. You can also probably go through settings. Honestly, I'm not sure exactly where you will go to get the columns here. So I just right click whatever I need, insert column before the delta column, and I add whatever I need, which is basically only the theta. You go to the Greeks, you add the delta, and that's about it. I don't really add anything else. Quantity, prices, you can customize it in whichever way you think is the best. So this is how I create this window, obviously, and then it's pretty simple. You just go, you sell, you buy whatever you need, go to profile. Then if you want to place an order, you just press submit on the bottom right side. Now, let me close this tab and let's go over here, because I also customize my my portfolio window. So what I do is I go right click, doesn't matter on which column, and we can go to manage columns. Then you can see we can choose whatever we want. We can choose, let's say, IBKR or implied volatility, dividends. We have 26 week IB low, 26 52-week IB rank, which is just IBR. So we can click add. Then we can just, if we want, we can move it up or down. Doesn't matter. We can remove it. And these are the things that I have. So I have the unrealized P&L, so how much the position is up or down. I have the daily P&L, so how much the position is up or down today. The actual position, or whatever future it is, and then the actual position. Then we have the market value, how much is it worth today, the delta of the position, the portfolio theta of the position, and how many days are left to the expiration. So it's really, really simple. The position, how much is it worth today, the delta, the portfolio theta of the position, and how many days are left until the position is going to expire. This is about it. Now, when you open the unrealized P&L, you want to right click it. You want to go to display both, and you want to display both value and percentage. So usually by default it will be only value, but you want to see both value and percentage, so you can know how much you're up and down in your position, not just in dollar amount, but also in terms of percentage of your credit or your premium that you received or you paid for. I think this is about it for this video. It was pretty comprehensive, I hope. It was just the basics, the things that are really, really important when you basically sell options or trade options and futures. And again, if you have any questions, please let me know. But that should be it. And thank you so much, and I will catch you in the next one.